The new activism cycle is testing strategic credibility. As 2026 begins, shareholder activism is no longer confined to traditional governance disputes or short-term financial campaigns. It is increasingly intersecting with how companies define, govern, and execute their sustainability and ESG strategies, particularly in sectors facing energy transition pressures, infrastructure constraints, and rising stakeholder scrutiny. Data from Barclays shows that activist campaigns in 2025 reached record levels and carried through the end of the year, defying the usual seasonal slowdown. What differentiates this cycle is not simply volume, but how quickly ESG-linked concerns, capital allocation discipline, operational credibility, and governance oversight are translating into board changes and leadership turnover. For executive teams, the message is becoming harder to ignore. Sustainability strategy is no longer evaluated in isolation. It is being assessed alongside execution, sequencing, and accountability. ESG strategy is being judged on execution, not ambition. A defining feature of the current activism cycle is its focus on whether sustainability and transition commitments are operationally credible. Rather than challenging ESG goals outright, activists are questioning how those goals are governed, financed, and delivered. Barclays' analysis indicates that campaigns are increasingly targeting board composition and oversight structures, with activists securing seats through negotiated settlements rather than proxy fights. Many of these new directors bring prior CEO or CFO experience, reflecting a shift towards scrutinizing execution discipline, not just disclosure or policy alignment. This matters because ESG strategies are now being evaluated less on stated intent and more on whether management teams can demonstrate control over trade-offs, how capital is sequenced, how performance is measured, and how deviations are addressed. In this environment, credibility gaps between long-term sustainability narratives and near-term operational realities are becoming focal points for engagement. Governance is the lens through which ESG claims are tested. Governance has always been central to ESG frameworks, but activism is sharpening its role. Board effectiveness, independence, and sector expertise are increasingly viewed as determinants of whether sustainability strategies can withstand economic and operational stress. Rising CEO turnover following activist campaigns underscores this shift. Leadership changes are not being framed solely as performance corrections, but as governance resets. Signals that boards are recalibrating oversight in response to execution concerns tied to capital deployment, portfolio complexity, or transition pacing. For companies operating in energy, infrastructure, manufacturing, and transportation, this governance scrutiny is particularly acute. These sectors face long asset lives, regulatory exposure, and material transition costs, making ESG execution inseparable from enterprise strategy. Capital discipline has become an ESG issue. One of the most notable developments in the current cycle is how capital allocation has emerged as a sustainability issue in its own right. Activists are increasingly challenging whether companies are deploying capital in ways that align with stated ESG priorities, or whether investment plans lack coherence, accountability, or return discipline. This reflects broader market conditions entering 2026. Higher financing costs, constrained infrastructure capacity, and selective investor tolerance are compressing the window for experimentation. Sustainability investments that once benefited from patient capital are now expected to demonstrate clearer pathways to value creation or risk mitigation. In this context, activism is acting as a forcing mechanism. It is compelling companies to articulate not just what they plan to do on ESG, but when, how, and at what cost. The absence of those answers is increasingly difficult to defend. Stakeholder engagement is becoming less predictable. Compounding these pressures is a shift in the shareholder landscape itself. Ownership concentration among large index managers continues to rise, while stewardship teams are being reorganized around asset class and mandate. This has introduced greater variability into engagement dynamics, particularly around ESG priorities. At the same time, activist investors are showing less deference to traditional engagement timelines, launching campaigns as soon as valuation or execution concerns emerge. For issuers, this means ESG narratives can be tested abruptly, outside of reporting cycles or proxy seasons. The result is a more fluid and less procedural engagement environment where sustainability strategy is continuously assessed against market and operational conditions. What sustainability and executive leaders should reassess? The current activism cycle suggests that ESG credibility is becoming inseparable from enterprise credibility. For leadership teams, this raises fundamental questions heading into 2026. Are sustainability commitments clearly governed at the board level? Does capital allocation reflect stated ESG priorities in a defensible way? Can management demonstrate control over sequencing, trade-offs, and performance measurement? Activism is no longer a challenge to ESG itself. It is a test of whether sustainability strategies are mature enough to withstand scrutiny when capital tightens and execution matters most. Companies that treat ESG as a parallel narrative risk being challenged. Those that integrate it fully into strategy, governance, and capital planning may find the current cycle reinforces, not undermines, their long-term positioning. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.